Welcome to the channel. In this video, we will talk about the current economic situation and how it compares to past recessions. Since the pandemic, we have witnessed a gradual global economic recovery, but we face one of the main risks: high inflation levels. Although the global economy seems to be recovering at first glance, economic prospects remain uncertain and the situation is quite fragile. Are we facing a new recession? To answer this question, we need to know the background of the last crises and how they relate to the current situation. The crisis of 2000, also known as the dot-com bubble, was an economic crisis that mainly affected technology companies and the stock market. In the 1990s, there was a boom in these types of companies due to the rapid expansion of the internet. As a result, many investors started investing in these stocks, which led to a bubble in the stock market. In 2001, the dot-com bubble burst. The stocks of many technology companies plummeted, resulting in the bankruptcy of many of them and significant losses for investors. The crisis affected other economic sectors and contributed to the economic recession that occurred in the United States in the early 2000s. The crisis of 2008 was caused by the real estate bubble in the United States and the sale of high-risk mortgages. The Fed raised interest rates before the crisis to control inflation and prevent a bubble in the real estate market. However, the Fed had to start lowering interest rates and taking other stimulus measures to combat the crisis and prevent a collapse of the financial system. The crisis of 2020 was caused by the pandemic and its economic consequences. The Fed had been gradually raising interest rates before the crisis to normalize monetary policy after the 2008 financial crisis, but had to reverse this policy and lower interest rates to almost zero to support the economy during the pandemic. The Fed also implemented additional economic stimulus measures to support the economy. As we can see from the previous crises, we can determine that in all cases, there were three common factors: a rise in rates by the Fed to cope with an increase in inflation, a crisis in the financial market, and a process of lowering rates to face that crisis. If we analyze the current situation, we can find that some of the aforementioned factors have been met, while others, according to several indicators, are about to occur.
One of the first factors we can identify is inflation and a rise in rates. In recent years, we have seen how inflation has been on the rise, reaching a maximum in the US of 9.06% in June 2022. The Federal Reserve, as a mechanism to counteract inflation, began an unprecedented rate hike process, with constant increases bringing the interest rate to current levels of 5%. This rapid increase in rates led to many companies, especially startups, running into problems. It is important to remember that these types of companies depend on bank financing. When rates rise, the cost of financing increases. With the situation mentioned above, many banks like Silicon Valley Bank or First Republic Bank began to have solvency problems, leading both banks to the limit, having to be rescued by other entities. All this translated into a banking crisis, which put the entire market on alert, as the domino effect could be a significant trigger for the rest of the banks. One of the main European banking sector reference, Credit Suisse, had to be rescued by its competitor UBS, with the backing of the Swiss government, in an attempt to tackle a domino effect on the global financial system. We have seen how currently, we identify two of the three factors that occurred in the last three major crises: inflation, rate hike, and a crisis in the financial market. We only have to remain alert and prepare ourselves for what appears to be an almost inevitable, major economic recession predicted to occur by the end of 2023 or early 2024. In summary, the global economy remains uncertain and fragile, and although we are in a recovery phase, it is important to keep an eye on economic indicators. While the current situation bears some resemblance to past recessions, there are also different factors that may influence the future of the global economy. Thank you for watching our video, and don't forget to subscribe to stay up to date on our latest developments in economics and finance.